Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important market update on this Thursday. As we've been doing recently, we've been doing 2 weekly updates in order to kind of keep you informed of what's going on and what we're seeing with the volatility of the market. We've seen some substantial volatility, which often scares investors. We often see this volatility as really an opportunity in certain sectors to really add to positions that we have that we feel fundamentally strong and feel are trending in exactly the right direction for our client portfolios. We're obviously looking at a number of factors. The FOMC meetings came out yesterday, and what I read into these meeting notes is the bottom line is QE2, or quantitative easing. The Fed's been pumping a lot of money into the system. I don't think that's going away anytime soon, and I would not be shocked, as I've talked about many times, that we'll see a better than 50% chance of QE3, meaning the Fed will continue to keep a very loose monetary policy, pump money into the market, keep that liquidity up, which ultimately is going to help reinflate certain asset prices. While housing is dismal, the numbers that came out this week are horrifically bad. I hate to say that I was right, but again, this is the third year in a row that real estate is down again substantially. Housing permits were about as bad as it's going to get. In fact, we are well off 80% from the highs of the builds we saw 5-6 years ago. So real estate, in my opinion, on the residential side is still on its way down. What we're seeing on the commercial and retail side, on Class A space, which would be your premium, nicer space for investment purposes, these properties have been bid up again almost to levels that we saw 6 years ago. Cap rates, which is basically kind of the rate of return or the net interest that's received after all expenses, these things are already bid back up to a cap of around 4. Traditionally, when caps are between 8 and 6, typically will show a buying opportunity, and obviously the higher the cap rate, the better the opportunity or more value that we're seeing in real estate. So for those of you who own REITs, especially publicly traded REITs, make sure you truly understand what you're getting yourself into. If the yield looks too good to be true, it may not be too good to be true, to be honest with you. It actually may be some value. But if you're finding that you bought real estate and that REIT has decreased substantially because of the valuation of those shares, that's where I would start getting nervous. So you really need to understand the different value propositions. Higher cap rates, of course, on real estate are promising and often will show value, and obviously lower cap rates mean prices have been bid up. A couple things that I do want to mention today, especially as we get further into this year, it's going to get tougher and tougher for the economy to plug along and to do good comparisons. Areas that we're looking at for protection, and again, upside potential and protection against a falling possible stock market later in the year. Again, we're watching our indicators closely. We still like gold, which we're going to be adding to positions in that. We still like commodities exposure. We continue to believe that commodity prices will ultimately go higher and higher over time as there's more demand on those resources. I believe looking at inverse ETFs, exchange traded funds, on bonds, when rates eventually start getting moved up slowly, not anytime soon, I believe ETFs, exchange traded on an inverse side, meaning when rates go up, bonds go down, and inverse funds does the exact opposite. So it's a way actually to profit when interest rates are going up to protect your bond portfolio. We are also looking at those scenarios too. Not yet, but we are watching them closely when we want to add those to a portfolio. Also, inverse ETFs that basically do the opposite of the stock market when it goes down. That's another way to protect your portfolio. Looking at currencies, as the US dollar will start, in my opinion, start to weaken again when we start to see more easing or easy money from the Fed. Obviously, currencies that are strong against the dollar. As the dollar weakens, obviously you lose money in the dollar if you're owning dollar currency or dollar assets. If you want to play the other side of that, the Chinese yuan would be one of the areas that you could play for currency, obviously on the upside as the dollar continues to get weaker. I believe the short-term jump up in the dollar is only temporary at best, and I believe ultimately we will see lower dollar in the U.S. for many, many years to come. I hope this update was informative for you, and as I've always said, if you don't have an investment strategy, then you don't have, obviously, a way to manage the risk within your portfolio. Risk management is the most important part about money management, but you do need a written investment strategy. What is your investment strategy? Is one being followed? Is the person you're currently using actually a money manager like Resney Wealth Management? If not, if you're finding that you have more of a salesperson than an actual money manager, you'd like to talk to our firm about managing your wealth, give us a call. We always like to sit down with investors who are serious about their portfolio and serious about making change to that. Give us a call, and until Sunday show, make sure you have yourself an extremely profitable week.